So let's think about, okay, your company now is getting ready to think about doing a transaction in the early part of next year. What does it mean? How do I drive value? How can I really think about things? So let's jump into a quick case study that I love to use. Let's assume that same $50 million, 10% revenue growth, 10% margin EBITDA, valued at 6 times EBITDA. Theoretically worth $30 million today. Not a bad outcome for a motivated seller. But should I wait? Should I sell later? What if I do? Should I get out now or should I wait? Again, it depends. If I wait and just let it run forward, I'm in 3 years from now, that company should theoretically be worth about 40 million, assuming all else being equal. Not a bad outcome by waiting, if that's the objective of the owner. However, without preparation, what happens? Usually there's a retrade. Something's found in due diligence. You're not quite ready. The valuation isn't what quote unquote market would be. And you can expect a 10, 15, 20% discount at the closing table. So realistically, you're going to be about 33 million. Was it worth waiting? Not if you don't prepare. If you prepare, then the opposite is true. Let's say you start managing for value, okay, and you really think about what's driving that outcome. And there's really 2 ways to do it. Remember our original formula of EBITDA or earnings times a multiple. So if I increase EBITDA by 1% a year, I'm sure that every one of the people on this phone call right now can find somewhere buried in their financials 1% this year and 1% next year. Whether that be a price increase, whether that be rationalizing some vendors, whether that be just paying attention to expenses, 1%, not all that hard. And taking that EBITDA or that multiple from a 6 multiple to a 7 multiple. How? Streamlining operations, by improving EBITDA, by having momentum going into the transaction. What's the result of that? Believe it or not, 1% a year and moving the multiple from a 6 to a 7 will add nearly $30 million of enterprise value, nearly twice the valuation by those 2 very simple metrics. Planning and preparing does make a huge difference, and the more time you have, the better off you're going to be. So that is, believe it or not, how simple sometimes it can be. So let's dive into what really drives value. And I'm sorry for the small eye chart here, but it's the only way we can explain it. So if we look at that basic business, 50 million, 5 million, $6 million valuation, and you say, if I were to grow forward, if we look at the bottom blue line, the base case scenario is that if I ran it without any improvement, just business as usual, be worth $48 million in 5 years from now. The prior chart was 3, this is 5 years. This is how our private equity folks were going to look at it. So I'm going to get $48 million for my $30 million business. If I accelerate growth by 10%, meaning I go from 10% and then I'm up 1% the year after that, then I'm up 1.1% the year after that, and really start to accelerate growth, and I change nothing else, then the business could be worth about $56 million. If I take that multiple and go from a 6 multiple to an 8 multiple over that same 5-year period and change nothing else, then it could be worth $64 million. But if I find 1% of EBITDA and I take it from a 10% margin to a 15% margin, just with that one variable alone, not changing anything else, the company would be worth $72 million. If, however, I do all of them, I improve revenue by 10% or 1%, accelerate revenue by 1% a year, I find 1% of EBITDA a year, so I go from 10 to 15%, and I improve the multiple from a 6 to an 8 because you get credit for momentum. If I do all of those 3 things, it could potentially be worth $112 million. So that's the revenue, that's the private equity model, that's the value levers that people look at. Revenue growth, EBITDA growth, multiple expansion. Not too bad. So where do I start? Therein lies the best question of all. First and foremost, build your team. We cannot underestimate the value of a really good, highly trusted, collaborative team of expert advisors. As we like to say, if you're going to sell your business once, do it right the first time. And what does that mean? That means hire the best investment bank, accounting team, wealth team, and legal team you possibly can find. Not all of them are created equal. As we always like to say, a dentist and a brain surgeon are both doctors. They're both really good at what they do, but I would never use a dentist to do brain surgery. So what does that translate to? When you're talking about your legal advisor, don't use your contract attorney, your divorce attorney, your real estate attorney. Use an M&A professional. When you're talking about your accounting team, usually upgrade to a larger firm, a more reputable firm. Get a quality of earnings report done that is specifically tailored for an M&A process. Hire the best tax experts you can to minimize your tax exposure through both structure and some planning. When it comes to your wealth team, think about not what the proceeds of this transaction are, but what does it mean for the next generation and multiple generations after that? How do I look at minimizing taxes, and what am I going to do with all the money at the end of the day? And really look at and do that planning well in advance of doing it. So the best first step that you could possibly take right now is to go get your legal team, get your accounting team, get your wealth management team, and your investment bank all lined up, ready to do the transaction. The more time that group has to work together in advance of a transaction, the better the outcome is at the other side. We cannot overstate the importance of having that really good, trusted, collaborative advisor network of experts. Upgrade, upgrade, upgrade all the way around. Those folks will then pull in that outer circle of other experts that they can rely on for very specific tasks that are going to be important going forward. But as we like to say, and you'll see some articles from us, the core four need to be put in place first, and then those have their spider webs out to other networks of experts. So what do I do now? That's probably your question. At least I hope it is. First and foremost, 6 months prior, if you're going to do a transaction next year, start now. Get your trust and estates plan in place. Think about all the alphabet soup of potential structures. Give low basis stock away using today's valuation of the company, using estate planning techniques, which is valued differently than M&A techniques. Use that to set up your slats, your grats, your IDTs. Get trust for the kids, for philanthropic endeavors, for minimizing taxes. If we increase the purchase price by 20 or 30%, that's great. But if Uncle Sam's going to take half when you die, why bother? So think about that tax minimalization strategy as you go forward, and really make sure that that structure and that planning's in place. Part and parcel to that is going to be, if you've now converted this illiquid asset of your company now to cash, what are you going to do with it? How are you going to allocate that? What are the dreams and wishes and expectations going forward? How much do I need to live on? Most business owners expense a lot through their businesses, right? They're in a tax minimalization strategy, not a value maximization strategy. So now that we don't have the business to wash that through, well, now what? How do I afford that second or third or fourth house? How do I think about vacations and expenses and country clubs and boats? So we have to have that before you embark on this, so that you have the confidence at closing to say, I got the right amount. If you look at other long lead time issues, the environmental, especially for most manufacturing companies, is really important. It's a long lead time item. You don't want any surprises. So 6 months prior to thinking about doing a transaction, go get a phase one. They're really not that expensive, and they have huge dividends on the outset. Clarity and full disclosure are going to be really helpful here, especially when it comes to environmental. Case in point, we did a transaction a couple of years ago where the buyer found some environmental issues, and they wanted a $6 million reduction in purchase price to cover any and all environmental issues. $6 million. Well, we took it upon ourselves. We put the transaction on hold. We took it upon ourselves. The company did, and for $350,000, remediated the tiny little issue and confirmed there was no future issues. We saved ourselves $6 million by getting ahead of it and addressing it in advance. it will pay huge dividends on the back end. Go get your environmental phase one. The other big important thing that most owners forget about doing in advance is doing some management incentive planning. Any management team would like to be part of a successful exit and be incentivized to stay with the new owner going forward. That takes some planning. That takes some creative minds. It takes some time to put that in place. Ideally, that's 6 to 12 months prior to transaction. So if you structure it right, at least management teams can get long-term capital gains if it turns out to be an equity grant at today's value. So doing that in advance really helps. It's much easier to do it in advance than it is at the closing table. Most importantly is really think about addressable issues. Everybody has some low-hanging fruit that's there. So go, you know what they are, go fix them. And that value is totally accretive to the company and the management team going forward, and gives you momentum, and you get credit for momentum. At the end of this year, here's the other things you're going to start planning. Upgrade to an audit. It's amazing to me that we can deal with companies with hundreds of millions of dollars of revenue that still have a review, and that doesn't cut it. So upgrade to an audit, get your Q of E, a quality of earnings report, up and running, and really stay on top of it. As you go into year end, make sure that you've really thought about working capital. If you can minimize your receivables, minimize your inventory, stretch out your payables. When you do the transaction, they look back 12 months. So if you can start doing that now and managing it, it just leads to an incremental purchase price at the end. And then obviously do all the right accruals and stuff, but you all have that under control. 3 months prior, engage legal counsel. Really start to look at the major line items, the major contracts, the certifications, the licenses, the I-9s, all the different issues that need to be addressed. The more time is better. 3 months, 6 months is really the right time to do that. Start building your data room. All the major contracts, all the major vendors, all the major financial reports. Start really thinking about building that data room to make the transition smoother. Work that goes into an M&A transaction is fixed. It's the same amount, no matter how much time you allot to it. The earlier you start, the easier it is to manage. Because if you get into a process and you got to do the same amount of work with a short period of time, it just stresses everything out. So we also recommend engaging or re-engaging with really important clients. There will be reference checks to clients and key vendors prior to the closing of the transaction. Get them on your side. Think about how they will espouse your praises as you go forward. Nothing worse than doing a surprise customer visit or a vendor call, either just before closing or just after closing, and an issue is discovered. Discover that prior to ever starting, address that issue, and then you make sure it's smooth going forward. So here's the biggest question of the day. When do I call my friendly investment banker? Anytime you need to educate, explaining the process, developing an exit strategy, understanding what's motivating buyers and sellers, to think about all the different options. Remember the Gantt chart we showed before of minority, majority, refinance, majority equity, LBO, strategic transaction. And a quick reality check. What we find is most owners think their business is worth a lot more than it might be. So let's do a reality check of what the market's going to look at today and make sure that expectations are met going through the transaction. And really, for us, one of the values we can bring is really understanding the key value drivers. Business owners that have been running their companies for 10, 20, 30 years or generations tend to lose value of what the market thinks are value drivers as opposed to what they think are value drivers. And so there's definitely some strategies that can be put in place in advance of a transaction to really maximize that shareholder value and minimize risk. So if we can ever be helpful, or your local investment banker can be helpful, engage them early. Most of us love to have the conversation about how to drive value and how to end a successful transaction. So with that, we made it. We got about 10 minutes left through here to answer any and all questions you might have. Here's my contact information. Please feel free to reach out to me directly, or better yet, channel it through Bruce and the folks over at Fang, and happy to go from there.